everybody. Thanks for joining in today. I'm Yolanda Chu, real estate specialist with Home Life Bestseller. Today I have with me Kai Liu, mobile mortgage broker with Capital Lending Center. Welcome, Kai.
Hi everyone. Hi Yolanda. Thank you so
How
much
are,
for the opportunity. Good to have you
how
here.
are you?
Good. I'm good. Thank you very much.
Why don't we start with you telling us a bit about yourself and what your business model is like?
Certainly. So my name is Kai. I'm a full-time mortgage broker. So I help clients with their mortgages, either to purchase a home, consolidate debts with a mortgage, or take equity out through a mortgage. So a lot of people know mortgages. You use mortgage to buy a home. That's absolutely true. So I do help clients get into home ownership, but mortgages are more powerful than that. So for example, you can put expensive debts and roll them into the mortgage. So rather than you paying 20% on your credit cards, you can just pay 2 to 3% with just a mortgage with exactly the same balance. So you can
That's
save
a
quite a bit of
really
money.
good tip,
Yeah,
actually.
save quite a
Yeah,
bit of money and improve your cash flow substantially.
that's really good to know. So, okay, what are like the do's and don'ts of a mortgage application?
So there are about 5 do's and 4 don'ts. We're going to go through that. So first do is to get a pre-approval. So
Okay.
a pre-approval is going to help you determine your affordability and also the down payment requirement as well as the credit score requirement. So with a pre-approval on hand, very likely you're going to know what your price range is. So you can narrow down the type of home that you're going to go out and seek. That's going to save you quite a bit of time.
Right, so they don't over budget.
Exactly. So for
Right.
example, if somebody can qualify for, let's say 1 million, then there's really no need to look at the $2 million homes, right?
Of course, yeah.
Yeah. So also it's gonna let you know how much down payment the lenders they're gonna require, so you know exactly how much to prepare. Yeah.
And
Also,
usually, what deposits are lenders looking for minimum these days?
that's a very good question. Here in Ontario, we can start with just 5% for these homes under 500,000.
Okay, great.
Yeah. So the second do is to do your comparison as well as your due diligence. Rates are at the extremely low these days, but rate is not everything. I'll give you some example. Some of the really no-frills, like extremely attractive rates, they do require you to purchase mortgage insurance. Now that's going to cost you about 2 to 4% of the entire mortgage. So overall, if we look at the overall picture, is it going to really save you money? Like the rate is amazing, like a 1.5 something, 1.6, but is it going to
Right.
really save you money after the 2 to 4% of the mortgage? But we have to take another look,
Of
right?
course, yes. Okay.
Yeah. Also, some of these really low rates mortgages, they don't allow you to do secondary financing. So if you really have to tap into your home equity for borrowing, they won't allow you.
Okay, that's really good to know as well. I didn't know that actually. That's really nice. Okay.
Yeah, some of the terms they're pretty strict.
Okay.
The third one is to collect your documents upfront because getting documents ready actually takes more time than most people think. So in
Yes.
order to reduce the turnaround time, I always recommend clients to have the documents ready as soon as possible. That's gonna
And what are like some of the starting documents, like minimum documents that they have to look for?
Yeah, good question. So minimum documents are ID and also notice assessments from the CRA, showing that there's no tax owing to the CRA, and also T1 general as well, to give me an idea how they get their income and what type of income they're getting. So these are
Got
the
it. Got it.
starting documents.
That's good. Okay.
Yeah. So the fourth one is to stay in touch with me or whoever you're using for doing your mortgages, because lenders they do change their policy. I'll give you
Okay.
just a very recent example. I have a major B lender. They're no longer lending in Sudbury.
Okay.
So, for example, if you were looking at buying property in Sudbury, let's say last year, this year you won't be able to get a mortgage from them because then they have suspended their business in Sudbury.
Okay. Interesting.
Yeah. So do speak to your mortgage broker or myself. because the lenders change their policy not only on the lending areas, they also change their policy on the debt service ratios. Some of them, they do adjust their requirements on credit score. So talk with your broker as often as possible.
Right. Always use the experienced professional.
Yeah, exactly. Okay, so the last one is to read the pre-approval documents. So once you get the pre-approval documents from the A lenders, read it, and make sure you understand it as well. So check the amount likely they can approve you for, the interest rate, and also the monthly payment, because the monthly payment is gonna let you know if it's within your affordability as well, right? So if
Right.
somebody is comfortable with $3,000 and the mortgage payment is $4,000, so you know likely you might want to increase the down payment and reduce the mortgage to make the monthly payment more affordable for yourself.
Well, that's good to know.
Yeah. So these are the do's. I also have about 4 do nots.
Okay.
So first one is don't max out, stay within your budget. So I'll give you a very basic example. So let's say if the lender approves you for 600,000 and you have about 200,000 in down payment. So maximum you're looking at somewhere around 800,000 for the purchase, right?
Right.
But do you really want to offer 800,000? I think we might have to take another second look as well, because right after closing, actually on the closing day, you're gonna pay land transfer tax, legal fees, and also you're gonna need funds for buy furniture as well. Very likely when you move into the house. Of
course, yeah.
Yeah, property tax, insurance, they can really pile up really fast.
Like all the external expenses on top of purchasing the home.
Yeah, exactly.
Yeah.
And some of the homes, they do require some renovation, a little bit touch up here and there. So you do need to build some emergency funds for all of these.
Of course. So what percentage usually would you suggest the clients to have as the saved amount?
Saved amount? Okay, so I got this advice from a financial planner. So usually it's 3-month income. So let's say if I'm making 4,000 a month, so likely you're gonna need about 12,000 sitting in your bank account just as an emergency fund. That's gonna give you quite a bit of safety buffer.
That's very good to know, actually.
Yeah.
All right.
So second tip is don't buy expensive items on credit cards.
Ooh, that's tough, especially with Christmas around the corner.
Exactly. That's going to be a bit challenging for people who really need to buy expensive things, but try not to, because once you purchase an expensive item on your credit card, it's going to change the debt service ratios. Now we can talk about debt service ratios for probably an hour or two, but I just want to simplify things for everybody. Okay. So debt service ratios are what the lenders use to assess your affordability. Now, when you buy something expensive on a credit card, your debt service ratio is gonna go up. The higher the ratios, the less the mortgage you can get. So try to avoid buying expensive things on credit cards during this house hunting period. Now, once you close your property, you can buy whatever you please, but during this period—
That's also not suggested, though.
That's true.
All right.
Yeah. So that's the second tip. Third one, it's very similar. Do not apply for another credit loans, for example, installment loans. For the same reason, once you have another loan, your debt service ratio is going to go up. Once your debt service ratio goes up, your affordability on the mortgage goes down. That means for exactly the same home, when you have less of a mortgage, you need to prepare more down payments.
Got it. Okay.
Yeah. Okay, so the last one is don't change your job.
That seems pretty logical, but okay.
Yeah, that's true. For most people, we understand that your job isn't the perfect fit for you, but stick with it. The reason is once you change your job, the lenders, they're gonna ask, so how are you gonna make the payments? Because you just change your job. Now, in most cases, I also understand, in most cases, people do move into a higher paying job in most cases. Mm-hmm. But if the lenders don't see the certainty that your income is going to be higher, or if you have, let's say, if you have to go through a probation and the lenders don't have the faith or they don't see the uncertainty, it's easier for them to say, no, we're not interested.
And this can also change even if you're pre-approved?
this can also change as well. Good point you're bringing up. That's a very good point. So pre-approval doesn't really mean approval.
Okay.
So the lenders, they have, so if you change your job, the lenders, they do have the right to cancel the pre-approval and redo the underwriting.
Okay, so that's
Or,
something everyone should know as well. Just because you're pre-approved doesn't mean you're actually approved.
that's right. And also the lenders will also look at the property, because the pre-approval, it doesn't involve the property. Once you have a
Right.
property that you want to buy, you send it to the lender for underwriting, they're gonna look at the property as well. So like I was telling you, so if I get a pre-approval, let's say for GTA for buying the house at 1 million, now when I go to subrate, I want to go to the B land I was telling you about. Even if I'm pre-approved, there's no point because they're not lending in subrate.
Got it. Okay, fair enough.
Yeah, so these are the do's and don'ts.
Okay, great. So I know a lot of clients right now, because we do have multiple offers in the market these days. A lot of clients are waiving the finance condition, and I know that's a red flag for lenders. Why is that?
So that's a very good point as well. So from the lender's perspective, now like I was telling you, the lenders also have to look at the property to determine if they are willing to lend and how much they are willing to lend on it. So waiving the financing condition, it's a great strategy because these days, if you want to win the bidding war, you will have to waive a condition or two. But from the lender's perspective, they have a right to say no, even at the last minute. If the property is not in good, let's say if the property has structural problems,
Right.
you probably, as a buyer, you probably want to avoid that, and as the lender, they will definitely avoid that. So even at the last minute, they have a right to say no, we don't want to land on this property.
Got it. Got it. Okay, so what are, I guess, the negatives for the buyers for waiving the finance condition, besides that the lender may not approve?
So from the buyer's perspective, we don't really recommend anybody to go in our firm because let's say hold on a second. Let me just go through that. Okay, so for example, if the lender where you get your pre-approvals from is not lending on the type of property, they have the right not to give you the mortgage. But now, because you went all in and all firm, you really have to use a private lender, or I can help you go to other lenders, no problem. But if you do have to use a private lender or B lender, now the financing cost is gonna be higher as compared to using an A lender. So that's a negative side of going off firm.
Of course. Okay, so for Kai, we have his articles that will be published on the website. And if you want more information about him, link us on www.parkbench.com/Westbrook. All his information will be there. And if you or anybody else would like to be featured on the site, please link me directly at uchu@consultant.com or call me at 647-271-5376. Thank you, Kai, and bye, guys.